Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome back to Intelligent Investor Insights. I'm Josh Barone, and with me is my dad, Dr. Robert Bob Barone. Today, we're going to talk about something that sounds abstract, but is actually very concrete for your portfolio: the architecture of fragility in the financial system.
Thanks, Josh. And let me say up front, this is not about doomsday talk. It's about structural reality. The system on the surface still looks pretty stable. Banks are open, markets trade every day, credit keeps flowing. But underneath, the beams are rotting.
Yeah, I like to think of it as a beautiful house built on stilts that have termites. The paint looks fresh, the landscaping is great, but if you look underneath, the supports are getting eaten away. Interest rates and volatility have exposed a lot of those weak spots in banks, private credit, and commercial real estate.
Exactly. For more than a decade, we built habits and business models around basically zero interest rates. Then very quickly that world ended. Now we have elevated rates and chronic volatility, and the system that grew up in the old regime isn't really designed for this new one.
So in this episode, we're going to walk through where those termites actually are. We'll start with commercial real estate and regional banks, then talk about amend and extend and zombie loans. We'll get into the mirage of fair value in private markets, underwater securities portfolios, the shadow banking nexus, the illiquidity traps in private funds, and finally, the regulatory blind spots that mean we're all kind of flying blind.
And as we go, I want listeners to remember, this isn't just academic. If you own bank stocks, bond funds, private equity, private credit, pension plans, or even just broad index exposure, you are tied into this architecture, whether you like it or not.
Right. Our job today is to translate a pretty dense macro picture into something you can actually use. Not to scare you, but to keep you from being lulled by the illusion of stability. With that, let's start where a lot of this risk is concentrated: commercial real estate and regional banks. So Dad, let's talk commercial real estate, or CRE. Everybody's heard about struggling office buildings, but the systemic piece most people miss is how much of that debt sits on the balance sheets of regional banks.
That's right. Regional and smaller banks collectively hold roughly 70% of the about $3 trillion in U.S. commercial real estate loans. Many of those banks have loan books where CRE exposure is many times their actual capital base. That's a structural vulnerability, not just a bad quarter.
And that vulnerability is running straight into what people are calling a maturity wall. We've got nearly $1 trillion in CRE debt that had to be refinanced in 2025 alone, and more than $2 trillion between 2025 and 2027. That's almost double the historical average volume.
Yes, and those loans were often underwritten in a totally different world. Think about a building that was financed when rates were 3%. The debt service penciled out. The lender looked at a nice debt service coverage ratio, felt comfortable, and made the loan. Now roll the tape forward, and the refinancing rate might be 7% or higher.
So the same property, same rent roll, but the interest cost more than doubles. The cash flow that used to comfortably cover the loan suddenly doesn't. That DSCR, debt service coverage, collapses, and the borrower can't really service the debt from operating income anymore.
And that's just the first leg of what I'd call a triple threat. The second is structural. The way we use space has changed. Hybrid and remote work have taken a permanent bite out of demand for B and C class office buildings. Those are the ones with older layouts, less attractive locations, and they're the most vulnerable.
Yeah, it's one thing if you own a trophy building in a prime spot. It's another if you've got a 40-year-old office tower in a second tier downtown that's now half empty. I've looked at client portfolios where the anchor tenant cut their footprint by 50% and the debt still assumes the old rent roll.
Which leads to the third part of the triple threat, loan to value ratios. With falling property values, many loans are now effectively upside down. What was underwritten at, say, 65% loan to value might now be 90 or 100% because the building is worth far less. That inversion is a big problem for both borrowers and lenders.
When I'm looking at a regional bank for a client, I'm not just asking what's their earnings per share next quarter. I want to know what percentage of their loan book is CRE, how concentrated that is in office, where those properties are located, what the vintage is, and how much of that debt is rolling over in the next few years.
That's the underbelly of the balance sheet, the maturity schedule, and the quality of the collateral. Because if a bank has a big chunk of loans hitting that 2025, 2027 wall tied to lower quality properties, the risk isn't theoretical, it's scheduled.
And that's why you're seeing all sorts of creative behavior to avoid realizing losses right now. Which brings us to this nice sounding phrase, amend and extend. Let's unpack what that really is. All right, amend and extend. It sounds like a yoga pose, but in banking, it's more like contortionism. Dad, walk us through what banks and borrowers are actually doing here.
In simple terms, when a loan comes due and the borrower can't refinance at current market terms without blowing up their cash flow, the lender has a choice. Recognize the loss, restructure, maybe foreclose, or avoid that pain by amending the terms and extending the maturity. You tweak the rate, maybe give an interest-only period, and push the problem into the future.
So on paper, everything's fine. The loan is still performing. The bank doesn't have to mark down the value of the loan or recognize a charge-off. But the building hasn't magically filled up with tenants, and the economics haven't improved just because the calendar moved.
Exactly. You've essentially created a zombie loan. It's alive in the accounting sense, but economically it's impaired. The more of these you stack on a balance sheet, the more you're building a wall of future defaults. You're exchanging a series of smaller, manageable losses today for the risk of a larger, more catastrophic adjustment later.
I remember in prior cycles, we saw the same playbook. I won't name the bank, but years ago, we watched a regional institution quietly roll loans over and over because they didn't want to crystallize losses on local real estate they'd financed. The official numbers looked okay, right up until they didn't. Then, all at once, you had a wave of downgrades and capital raises.
That's the hubris embedded in this behavior. There's this belief that time by itself will heal the problem. But when the problem is structural, like a secular shift in demand for office space or a permanently higher cost of capital, time without price adjustment just stores up more tension in the system.
From an investor's perspective, what do you do with that? When I'm underwriting bank exposure for clients, whether it's individual stocks or a fund that's heavy on regionals, I'm assuming there's a cohort of zombie loans in the system already. So I'll stress test. What happens if a meaningful percentage of that CRE book has to be marked down 20, 30%? What does that do to their capital?
And you can't just look at the headline non-performing loan ratios, because by definition, amend and extend prevents those loans from being categorized as non-performing. You have to read the footnotes, look at maturity schedules, listen carefully to what management says and what they don't say about extensions and modifications.
The takeaway here is that delay isn't free. Every extend and pretend decision is a choice to push risk forward and increase the eventual impact when economic gravity reasserts itself. And this same mentality shows up outside traditional banking too, especially in private markets where valuation is a lot more flexible. Let's go there next. Private markets have had an incredible run in the last decade. Private equity, private credit, venture funds, a lot of investors have been told, don't worry about the volatility you see in public markets. Our returns are smoother. Let's talk about why that smoothness can be a mirage.
The core issue is how these assets are valued. Many private market holdings fall into what accounting standards call level 3 assets, where there's no active market price. So managers use internal models and assumptions to arrive at a so-called fair value. That's often mark to model, not mark to market.
And those models can be very sensitive to interest rates and cash flow assumptions. When rates go up and volatility rises, you'd expect the discount rate in those models to go up, which should push valuations down. But what we've seen is a lot of reported net asset values that barely budged, even as public market equivalents got hit pretty hard.
Exactly. Remember, we're talking about a private capital complex that's roughly $12 trillion in size. That's not a niche. In a higher for longer rate environment, highly leveraged portfolio companies in private equity and private credit should be feeling serious pressure. Their interest expense goes up, their earnings get squeezed, and the equity cushion should shrink.
But because the manager controls the valuation process, there is a temptation and, frankly, a financial incentive to smooth the ride. You don't adjust valuations as aggressively as the public market would. So the quarterly report looks calm, but underneath, the credit quality may be deteriorating.
One of the clearest tells of that deterioration is the increasing use of payment in kind or PIK interest. Instead of paying interest in cash, the borrower adds it to the loan principal. On paper, there's no default. In reality, the company is saying, we don't have the cash to service this debt.
Yeah, if my kid came to me and said, Dad, instead of paying you back this month, can I just add what I owe to the tab? I wouldn't call that everything's fine. That's a sign of strain. PIK and other creative restructurings are like the private market version of amend and extend. They avoid the default label while compounding the problem.
Then layer on covenant-light structures. In the old world, loans had maintenance covenants, leverage ratios, coverage tests that gave lenders early warning when a borrower's condition was deteriorating. Today, more than 80% of institutional leverage loans are covenant light. Those warning lights have been dimmed or turned off.
Which means the transition from everything looks fine on the report to we have a default can be sudden and violent. As an investor, you don't get a slow drip of information. You get a cliff. That's why I treat private NAVs with a healthy dose of skepticism and cross-check them against what's happening in comparable public credits and in the secondary market.
The big picture is that the apparent stability in private markets is often a function of accounting discretion, not economic resilience. And that illusion of stability becomes dangerous when it's intertwined with the banking system. Let's talk about that next through the lens of bank securities portfolios and duration risk.
We've talked about the loan side of bank balance sheets. Let's move to the securities side, which turned out to be a major vulnerability in the last few years, especially through held to maturity or HTM portfolios.
Right. Banks hold a lot of securities, typically government and agency bonds, in HTM portfolios. The accounting rule there is simple. You carry them at amortized cost, ignoring market price fluctuations, on the assumption that you will hold them to maturity and get par value back.
That works fine in a world where interest rates are stable. But when you have an extremely rapid hiking cycle like we just went through, those fixed rate bonds lose value fast. you end up with portfolios that are deeply underwater economically, even though the accounting doesn't show it.
Data from the Federal Reserve and others showed that at the peak, unrealized losses on these securities were very large across the US banking system. They've moderated somewhat as rates have moved around, but the underlying reality is that a lot of capital is still tied up in low coupon bonds that are worth less than their book value.
And Silicon Valley Bank was the poster child for how this can go wrong. They had long duration assets in their HTM book funded by very flighty short-term deposits. When depositors started to run, they had to sell securities, and those unrealized quote unquote losses turned into very real capital hits overnight.
That's the duration gap problem. When you mismatch the maturity of your assets and liabilities, you're vulnerable to exactly that kind of scenario. In a world of digital banking and instant communications, your supposed ability to hold to maturity can vanish in an afternoon if you have to meet withdrawals.
From an investor standpoint, this is why I don't take reported book value at face value for banks. I want to know, what's the mark-to-market hit on those securities if they had to sell? How long is the duration? How dependent are they on deposits that can move quickly?
And there's another important angle, opportunity cost. When a bank's capital is trapped in low-yielding legacy assets, it can't easily pivot into higher-yielding new loans without taking those losses. So you get this illusion of growth. The balance sheet looks big, but the earning power is constrained, and the flexibility to adapt is reduced.
So between zombie CRE loans and underwater securities, a lot of the traditional banking sector is less robust than it appears. And this is before we connect it to what's happening in the so-called shadow banking world. Subscription lines, NAV lending, and all the tunnels between banks and private funds. Let's go there. When people hear shadow banking, they sometimes think of something illegal or sinister. That's not what we're talking about. We're talking about credit intermediation happening outside the traditional bank, deposit, and loan model, but still very much connected to it.
Yes, non-bank financial intermediation, NBFI, includes things like money market funds, hedge funds, private equity and credit funds, and a host of financing vehicles. They don't take insured deposits, but they borrow, lend, and transform maturities and liquidity in ways that can have systemic impact.
One of the main ways traditional banks are plugged into this world is through subscription lines, also called capital call facilities. Banks lend to private funds secured by the uncalled capital commitments of the fund's limited partners, the LPs.
Historically, those have been viewed as low risk. The logic is these are contractual commitments from sophisticated institutions, pensions, endowments, family offices. The bank advances short-term credit, and when the fund calls capital from the LPs, the line gets repaid. It greases the wheels.
But scale changes the story. When the volume of these facilities reaches into the hundreds of billions, they become a transmission channel. If LPs start facing liquidity stress, maybe because their public portfolios are down and they're over-allocated to private assets, their ability or willingness to meet those capital calls becomes a real question.
Then you add NAV lending on top of. That's where funds borrow against the value of their existing portfolio companies to fund distributions or pay fees. You are effectively putting leverage on top of already leveraged assets. It increases sensitivity to any downward move in valuations.
So a small adjustment in perceived asset value can trigger margin calls, forced asset sales, or covenant issues at the fund level, which then feed back into the banks that provided those lines. It's like underground tunnels connecting two cities. They look separate on the surface, but they're joined below.
And because much of this is outside the traditional regulatory perimeter, it's less visible and less well understood. But make no mistake, banks are not just lenders to the real economy. They're also key infrastructure for the private equity and private credit machine. When that machine seizes up due to high rates, lack of exits, or LP strain, the impact lands on bank balance sheets too.
For our listeners, the message isn't never touch anything connected to shadow banking. It's understand that risk doesn't disappear when it moves from public to private. It just gets harder to see. And one of the biggest amplifiers of that hidden risk is illiquidity. Let's dig into that. Let's talk about illiquidity. Private funds will tell you, we lock up your capital to protect the strategy, to avoid forced selling, to let managers focus on long-term value. There's some truth to that, but there's a darker side when the system is under stress.
Right. Lockups and redemption gates are structural features designed to match the liquidity of the fund with the illiquidity of the underlying assets. That's fine in normal times. The issue is that in stressed markets, those features can trap capital precisely when investors most need flexibility.
Think about a pension fund or an endowment. They have cash flow obligations, benefits to pay, operating budgets to fund. If a big chunk of their portfolio is in private funds with lockups, they can't access that capital quickly. So when they need cash, they turn to what they can sell, public equities and high-quality bonds.
That's one of the main channels of contagion. Distress in illiquid private assets forces selling in liquid public markets. You get downward pressure on asset prices that, ironically, are the ones you thought were safer and more transparent. This is part of how private market stress transmits into the broader financial system.
Then there's the denominator effect. When public markets fall, the value of liquid assets shrinks. The illiquid private assets don't get marked down as quickly or at all, so mechanically, they become a larger percentage of the total portfolio. Suddenly, your 20% target allocation to private markets is 30% on paper.
That can put institutions out of compliance with their own policy limits. To get back within range, they either have to stop committing to new private funds or sell existing stakes on the secondary market. And that's where reality intrudes on the mirage of stable NAVs.
Because in the secondary market, you see the real clearing price. And what we've been seeing in various parts of the private market world is 20 to 30% discounts to the reported net asset value. That's a pretty loud signal that the marks on the quarterly statements are optimistic.
Wider bid-ask spreads, discounted trades, and a lack of willing buyers at par all point in the same direction. Valuations are overstated. At the same time, you have exit paralysis. IPO markets are thin, M&A slows, and private equity funds can't sell portfolio companies as easily. Capital that was supposed to be returned to LPs is stuck.
That's what some people have called a reverse J curve. Instead of early losses and then gains, you get extended flat or negative returns while fees keep accruing and capital stays trapped. From my vantage point, when we look at private fund exposures, those secondary market discounts are one of the more honest barometers of value.
All of this is happening in a part of the system that, from a regulatory perspective, is still in the shadows. That brings us to what I think is one of the most serious structural problems, the regulatory data vacuum.
So far, we've talked about what's happening inside the system. Let's talk about what regulators can actually see, or more importantly, what they can't. You've been watching this for decades. How big is the blind spot here?
It's significant. Regulators have reasonably good visibility into traditional banks. They get detailed call reports, they see loan books, capital ratios, securities holdings. That doesn't mean they always act in time, but at least the data is there. In the non-bank financial intermediation sector, that level of transparency simply doesn't exist.
So in the private funds world, we don't have a standardized, comprehensive picture of leverage, of interconnected exposures, of how many subscription lines or NAV loans are layered in. It's more like trying to map a city at night with a flashlight. You see the street you're on, but not the whole grid.
That's a good analogy. Global regulators, central banks, the BIS, have been very clear that they're worried about this. They've described it as flying blind when it comes to assessing systemic risk in the shadow sector. And yet, most of the regulatory reform debate still focuses on bank capital. That's the last war.
Meanwhile, risk has migrated into private markets where disclosure is patchy, valuations are subjective, and leverage is harder to quantify. So you can have a pileup of exposures that only becomes visible when something breaks, when a fund gates redemptions, or a big LP can't meet capital calls, or a financing facility blows up.
Exactly. Without standardized, objective valuation methodologies and regular, transparent reporting for private assets, it's very difficult to run realistic systemic stress tests. Policy tools like macroprudential limits on leverage or mandatory liquidity buffers for funds are being discussed, but implementation has lagged the growth of the sector.
If and when we get a forced transparency regime, more rigorous reporting, constraints on leverage, clear rules on liquidity, there's a good chance it will coincide with a painful repricing. Because once you shine a light into the shadows, you often discover that the numbers people were using were, let's say, optimistic.
And that repricing can be disorderly if it's triggered by a shock rather than managed proactively. That's why I keep stressing that institutional trust in reported numbers, in regulatory oversight, is itself a kind of capital. When that trust is eroded, adjustment processes are more violent.
So we have an architecture where banks are vulnerable through CRE and securities. Private markets are vulnerable through leverage and opaque valuations. The two are interconnected through shadow banking tunnels, and regulators are looking at all this through a foggy windshield. That sounds reassuring.
Well, I did say we weren't here to be cheerleaders, but we're also not saying go to cash and hide under the bed. The more important question is, how do thoughtful investors navigate this environment? Let's close with a practical playbook.
All right, let's land this. We've painted a pretty stark picture of fragility in the system. Now, what do we actually do with that as investors and advisors? Let's start with banks, since they sit at the center of a lot of this.
For bank exposure, you have to look under the hood. That means examining the underbelly of the balance sheet, the concentration of CRE, especially office, the maturity profile of those loans, and the mark-to-market vulnerability of securities portfolios. Don't just look at earnings, look at risk.
When we evaluate a bank for a client, we're asking, if CRE values fall another 20% and refinancing terms stay tight, what happens to capital? If they had to realize losses on a chunk of HTM securities, what's left of their equity? We're effectively underwriting for the apocalypse, not because we think it's guaranteed, but because we want survivability.
On the private market side, treat reported NAVs as one input, not gospel. Cross-check them against secondary market discounts, public comparables, and the credit conditions we've discussed. If secondaries are clearing at 70 or 80 cents on the dollar, that tells you something about true value.
And ask hard questions of fund managers. How are you adjusting discount rates for higher interest rates? How much PIK or covenant light exposure is in the portfolio? What's your policy on gates and lockups in a stress scenario? If the answers are vague or hand-wavy, That's a signal.
Liquidity management is another key piece. You have to assume that in a real stress environment, the assets you think you can sell quickly and at fair prices may not be there. Redemption gates can go up, bid-ask spreads can widen, and buyers can disappear. Build genuine liquidity into portfolios, not just theoretical liquidity.
Yeah, I like to say cash and truly liquid, high quality assets are the oxygen in the room. You don't miss them until they're gone. We model scenarios where clients might need cash at the same time markets are under stress and private allocations are locked. Then we work backward to decide how much real liquidity they need.
And at the individual security level, focus on balance sheet strength and cash flow durability. Companies and institutions that don't rely on extend and pretend tactics, that can refinance in tough markets, and that don't need everything to go right in order to survive, those are the ones that make it through inflection points.
The common thread here is intellectual honesty. Don't buy into the illusion that stability in reported numbers means stability in reality. Interrogate the structure. Where is leverage hiding? Where is duration mismatched? Where is liquidity assumed but not guaranteed?
We are approaching, in my view, a significant inflection point. The maturity wall in CRE, the repricing pressure in private markets, the lingering unrealized losses in bank securities, all of that will over time collide with economic gravity. You don't need to time it perfectly. You need to be positioned so that when it happens, you're a survivor, not a casualty.
For our listeners, that means stress testing your own portfolio, asking better questions of the funds and institutions you're invested in, and being willing to sacrifice some short-term return to buy resilience. The goal isn't to win the next quarter. It's to still be compounding 5, 10, 20 years from now.
Exactly. Economic cycles come and go, but capital preserved through the hard parts is capital that can take advantage of opportunities when others are forced sellers. That's where real wealth is built.
All right, we'll leave it there for today. Dad, thanks for walking through the architecture of fragility with me and for not whacking my knuckles with a ruler this time.
You're welcome. I'll save the red pen for your next trade idea.
To all of you listening, thanks for joining us on Intelligent Investor Insights. If this helped you see the system a little more clearly, share it with someone who's still looking at the shiny surface and missing the structure underneath. I'm Josh Barone.
And I'm Bob Barone. Take care, stay disciplined, and we'll talk to you next time.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.